Today we're going to be talking about identifying high probability trading days, range expansions, and looking at some possibly the best opportunities that exist right now coming in the next few months. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacy Burke from Stacy Burke Trading. Hopefully everybody had a good weekend. I believe we're at an unprecedented time right now with global markets, multiple currencies, range expansions, oil, corn, gold. We have some opportunities that exist probably greater now than maybe at any other point in time. And today we're going to go more in depth. I had a lot of questions and emails over the weekend. I mentioned a phrase last day where I said you want to focus your trading and your energy on making money on the days that it's easy to make money. And it took me a long time to understand that. I heard that quote from somebody and it took me a long time to understand that. But it's about identifying the high probability days where there's very little stress involved, entering the market with a very tight stop, with asymmetrical risk reward where the market takes off and moves and there's very little heat against your position. It took me a long time to finesse a lot of poor quality setups out of my playbook and really narrow that down, as I mentioned, to a buy day trade setup, a sell day trade setup, and a trend trade setup, and a couple of variations of those. We're going to go through those today. We're going to talk about how to potentially identify the best days for trading. We talked about that last week, but today I just want to start off with a quote that Paul Tudor Jones talked about in Market Wizards that really resonated with me. And he said, the basic premise of his system is that markets move sharply when they move. If there is a sudden range expansion in a market that has been trading narrowly, human nature is to try to fade that price move. When you get a range expansion, the market is sending you a very loud, clear signal that the market is getting ready to move in the direction of that expansion. Now, we've talked about range expansions. I learned a ton of charting ways to approach asymmetrical risk reward through Peter Brandt. I've talked about getting his books, Schabacker, Edwards and McGee, and just getting back to basic trend analysis, because when we use our 50 pips a day, 12 candle system, it's a fantastic way for us to enter into the trend. Now, there's been a lot of traders who have been caught counter-trending trends, and that's where the misconception lies, where they're trying to buy low and sell high all the time. We're going to talk about that today. We're going to review our 12 candle system, and we're going to talk about identifying when the best times are for putting on risk with a tight downside and a maximum upside. So hopefully you get a lot out of this video. Let's get started. So what we're going to do today, we're going to review our simple system, but we're going to start off talking about structure, and we're going to look at some of the daily charts and give traders a bit more idea of looking at structure from the longer time frames. We do this on the daily levels charts, but today we're going to get a bit more specific in looking at some geometric patterns, because we've had multiple pairs of currencies and other instruments break out of geometrical ranges. We have range expansions that are currently in place, and this is again a great opportunity to go through the system and understand that fundamentally we are trend traders and we want to be trading with the trend. We're going to go through some of the trend trade setups on our 50 pips a day 12 candle system, and we're going to go through some setups that set up over the course of 3 sessions for selling high or buying low, and we're also going to go over some basic trend day setups for when the market is moving strongly in the direction of the overall structure and trend. So when we talk about structure, we talk about lots of different patterns. We can get head and shoulders, we can get rectangles, we can get 3-push patterns, we can get ascending triangles, descending triangles. If you're not sure what any of those are, again, I put Peter Brandt's books, the links for those down below, the classic charting patterns, Schabacker's book. Schabacker's book was the original text on technical analysis. Edwards and McGee is another one. Get those books, study those patterns, because they show up on every time frame. But when we get them on the longer time frames and we get range expansions, that's when we have the opportunity to have 3, 4, 5, maybe 2 months of movement, days in a row, months of movement in a strong direction. And we talk about not counter trending. I've learned that the hard way. Most of the damage that I did was counter trending markets and taking big losses. Even though I had multiple successful profitable trades, I would take a counter trend trade bigger and get smashed on those trades. And that's why I'm really big on making sure that when we trade these markets, our underlying fundamental trend is the direction that we want to be trading in.
Hey traders, looking at structure, just looking at the daily charts and looking at some of the markets that have started to move and possibly may continue to move. So last week we saw the British pound open up at the beginning of June, move towards the highs of the previous month in April, and we had a breakout on Friday. Now, we go back and we look and we see that this market has a gap up at the 29,53,000 area from back in March. This market is currently in a breakout. Obviously, this breakout could fail, but also it has the potential to possibly maybe do a range expansion of the previous rectangle that it was trading inside of. So again, we currently have a lot of markets that are in breakouts at the moment. We'll look at a few of those. Aussie dollar is another one. It came off a big peak off the low back in March before reversing. Again, just targeting some simple range expansions even from the beginning of the month. This market continued its move up before going into a ascending running wedge, and may not be as technically pure in the textbook sense, but we do have a market that is breaking out. And again, we talked about, if you want to know more about these geometrical patterns, grabbing Peter Brandt's book or Schabacher. We have multiple patterns within patterns, but this market is definitely in a breakout. And as Paul Tudor Jones talked about, if a market's moving in a certain direction, don't want to counter trend a strong breakout or a market that's in a range expansion. And currently, this market potentially may have still room to move further, even though it's possibly moving into a consolidation or a pullback. But we talked about identifying bigger structural patterns where markets may be entering into bigger range expansions for continuations of moves, possibly a mini head and shoulders reversal pattern, but again, a breakout of a monthly high and low from a range, now targeting possibly a second full range expansion on the New Zealand dollar. We've moved up one level, possibly two levels. And again, some of these pairs, the euro is another one. Just looking at some of the bigger structural patterns that are in place and watching how they've moved outside of these ranges. And these markets may still have room to continue trending. When we just target the basic sort of number boxes, we can see the euro's moved 500 pips plus and still possibly has room back towards the highs in March, up around that 1.1500 level. Again, these are markets, if they continue to trend strongly, we do not want to counter trend them. Canadian dollar had a nice descending triangle off of a big peak formation and has broken out. Currently moving still back towards the original breakout of its rectangle from back in May. We had a big rectangle, and then we have, of course, had smaller breakouts and measured move from back out in January, February. The point I'm trying to make is that when these markets break out, obviously these are potentially markets that are now trending, and we have the opportunity to participate in trending markets where we can position ourselves in a downtrend to sell high, or we can position ourselves in an uptrend to buy low. Aussie CAD, another market that has just taken off after coming off of a big peak formation low. We had a breakout. This market possibly could do a measured move of its range expansion to the downside. We have markets that are just completely out of balance at the moment. And again, until these markets go into consolidation, they may continue to move in the direction of that strong breakout. Mexican peso, we had 3 pushes into a peak, 1 push, 2 push, 3 pushes, and then a 1, 2, 3 little micro double top. So a pattern within a pattern, looking for a measured move outside of this range. Now, again, these markets, we may see these markets consolidate, but we may also see them expand in the opposite direction. We're currently at an unprecedented time, really, for a lot of these markets. And if you look back at these longer time frames, you'll see the significance of these breakouts. Looking at the peso on a monthly chart, we had a breakout of a symmetrical triangle, somewhat of a symmetrical triangle. And then we go to the daily and we can just see the size of some of these moves is absolutely huge. And again, when we're in these markets, we want to try and skew the odds in our favor. Now, normally I talk about trading primarily the British pound crosses, but what we really want to target are markets that are moving and trending, and then positioning ourselves in line with the trend and trying to, put the odds in our favor for having the least amount of stress or resistance to a profitable move.
We're going to go through some of the variations of those setups where they trick traders into trading against the trend and how we can recognize those. And then also we're going to talk about the timings, but price confirmation. Today we're going to go through and show some examples of entering the market with the trend, whether it's in the 12 candle window or whether it's knowing that the trade has already been triggered and that we want to stay with that trend in the 12 candle window and still keeping a tight stop. Targeting asymmetrical risk reward. Always we want to have a 1 bar stop or a 1 ATR stop and targeting 3, 4, 5, maybe 10 ATR of our risk. That's how you're going to make money. You're going to take losses, but when you can get 3 or 4 or 5 or 10 times your risk on the next trade, you understand why it's so important to take the loss. Process, performance, and remaining unemotional. Your job is to find the best setups. Your job is to execute your trading plan flawlessly to a T, managing your risk, managing your profit targets, and staying unemotional and purely business oriented in terms of performance. You get paid for performance. We are at a time right now where there's going to be a ton of opportunities. The markets are moving. There's a lot of opportunities, and if we stick to the basics and look for simple setups, we're going to get more than enough opportunities to profit from these markets. So let's get started. So one of the things we talked about last day was identifying the type of day that it possibly may be. We've got yesterday's high, we've got yesterday's low, and I talked about looking for markets that break one of those levels. And in a trending market, one of the first early indications is that we can see that initial burst in Asia breaking out and pulling back. That's the basic setup. So ideally, if we're in a trending market that's going up, we want to be able to buy low in a trending market. So sometimes what's going to happen is we'll come to London, they've done 3 pushes down, and in the Europe Open, they break out and take out the high, and they give you a sell high setup. It's a great setup, but it takes you back down into 3 pushes, often at round numbers, especially the British pound. The pound loves double zeros. You can make a note of that. So we've got Asia, London, and we saw this obviously on payrolls on Friday night. The trend has been trending all week. They came back in the US session, the 12 candle window, 7 o'clock reversal, payrolls at the high of the day, and then it broke through and continued its move before pulling back. This market moved 50 pips down and went into consolidation. The basic trend setups will often trap you against the trend, but we had 1 push, 2 push, and then the 3rd push continued the trend. So again, our overall daily high, making new highs, breaking out in Asia, pulling back, breaking out in London, selling it down, trapping traders with 1 push, 2 push, 3 pushes against the trend before continuing that move. Payrolls was a catalyst to continuing that strong move through the high of the London session. That's a basic trend setup. So we're looking at buying low with an uptrend. The same thing would apply in a downtrend.
Another example of a trending day, big strong trend, already intact. Initially, right in Asia, we have very little pullback. The market consolidates around round numbers before going 3 pushes into the previous day's high, and then reversing. We get 1 push, 2 push, 3 pushes, and an engulfment. And then a strong move back through the high of Asia and a 50 pip move from bottom to top into the London Open. Now again, we have 1 push. The market reverses in the London Open, back down towards traders that were long. And you'll notice again, they bring the market up higher just prior to the London market opening. And think about the psychology behind that. They bring people, some traders are into the end of Asia for the long trade. They come back and they bring traders shorting the beginning of the London session back down towards the breakout traders. But traders are shorting this market. They're trapping traders shorting the market. So hopefully they either take money off, go to break even. We get a bull candle, and then at the end of the hour, at the end of our 3-hour window, we get a second bull candle which engulfs the last bear candle down to the low at the previous day's high of the day. So we have 1 push, 2 pushes, the beginning of the 3rd push for a 50 pip move back up through the high of the day. And then of course, a second attempt at the peak, 1, 2, 3 in the US session, an engulfment and stop hunt before pulling back in consolidation. This is very good evidence of a very strong trending market. But 3 pushes with the trend before it finally went. So traders want to trade the trade long, they get stopped out. They get a gain, thinking the market's about ready to break. They go to break even, they don't take anything off the table, or they just hold on to it. The market comes back to stop hunt them at the Open of London before resuming the 3rd push for the 50 pip move. Again, just an example of 3 pushes with the trend before finally moving. Another example of a trending day in a strong trending market. We have consolidation near the high of the previous day. The Asian market breaks out of its high in that gap 3-hour window. And then in the Europe Open, breaks out through the previous day's high, 1, 2, 3, consolidation, London Open, pin hammer, 1, 2, 3, double inside bar. But then we get 1 push, 2 pushes, 3 pushes down, sideways. And again, traders ask, where do you get in? If you were watching this market, after 3 pushes, you would trade the engulfment candle. That's a pin hammer engulfment. But if we came in our 12 candle window, there's an existing long trade off the low of the day, the low of the London session, just prior to our 12 candle window. So there's an existing long trade open. The market breaks up 1, 2, 3, hits traders who are short at break even before coming back for the stop hunt against the long position. So some traders have gotten in somewhere after the fact. This market comes back to hit traders who are already long before giving the inside bar and a breakout. This is after payrolls, so the black bear candle is the payrolls candle. Okay, but point I'm making is there's an existing long trade in an uptrend after a 1, 2, 3. Market's broken out, pushed back 1, 2, 3, engulfment, pin hammer, breaks out again, hits traders at break even, stop hunts the traders who are long on payrolls, inside bar, breakout, pullback, continuation for 50 to 75 pip move in the upward direction. So an example again, of buying low in an uptrend. The Asian session did the same thing. So traders who got in early, the market came in Asia and opened in 1 push, 2 push, 3 pushes before engulfing, and then breaking through the smaller pattern inside the larger pattern on an engulfment to continue the trend. Uptrend, a breakout, pullback, continuation. Breakout, pullback, continuation. Okay, 1 push, 2 push, 3 pushes, engulfment, pin hammer over a doji into the US session 12 candle window. Stop hunt traders on payrolls, inside bar, continue the move back up with the trend. Trending day.
Now, if we had a downtrend, the market has come down the previous day. Again, we could have numbers here. Doesn't really matter what the numbers are. Asia may break out, pull back, push up, and then extend the range out in the Europe-London Open for a reversal back up. And they may again stop hunt the high in the US session for the move back down for the measured move. So again, we'll get a breakout trapping traders early that want to get into the trend. They chase the move. The market comes back to hit stops, drags them down further before coming back and hitting the stops. US, so London opens up down low in a downtrend, trapping traders back against the trend. So we've had 1 push, 2 pushes, and then 3 pushes, and a 1, 2, 3 in the US session before shifting and continuing the move down. So again, the trend trade, it breaks out low, takes traders further, traps them again just prior to the US market for the 3rd push. So we've got a 1, 2, and a 3. 3 pushes against the trend for the move back down. 3 pushes into the trend, or 3 pushes with the trend, and we'll take a look at that as well.
Another example of a sell-high setup in a downward trending market. Previous week had been in an extended range in the downtrend. Monday opens and immediately they break through the previous week's low and then extend the move another 50 pips through the low into the beginning of the London market open. In London, we get a breakout pullback, and you'll notice the last candle of the 2nd hour is a small candle. And again, traders ask, well, where do you get in? You can get in at a break of the low if you were going long. And again, the small candle, it's timings. It's all about timings. That's the end of the hour. It's a small candle. You trade the break of the candle. It's a breakout pullback. But what we also have is a first push into the trend. Okay. Then we consolidate after the stop hunt to the most recent swing low in the Asian session. So that was the redrawn high of the day. Market hits the highs, consolidates. 1 push, 2 push, 3 pushes. But we have 1 push, 2 push. Market pulls back, 1 push, 2 push, and then reverses. Actually, 1, 2, 3 shift candle, 1 push, 2 push, 3 pushes down, and then an engulfment long again. 1, 2, 3 to the high. That's our 3rd push to the high, right? So we talked about 3 push patterns against the trend. This is an example of a range extension. First, they break out. Then we have 1 push, 2 pushes, 3 pushes against the trend in a downward trending market. Engulfment, sideways, continuation. Traders want to position themselves after the engulfment at the high of the day in a downtrend for selling high anywhere at the numbers, anywhere in between the engulfment and a better fill price. So again, we talk about fighting for price. So some traders trade the close of the engulfment candle. Other traders may limit order somewhere up above there or market order, again with a stop above the high of the day. We have higher lows and the market comes back to get the trader who was long off the London Open candle at the end of the London hour. for a 50 pip move back towards the low of the day before it goes into consolidation. So again, an example of where the market did not follow through the low of the day for a measured move, but again, traders, even if they were filled at the numbers, would have got their 50 pips. 1, 2, 3 against the trend for a sell high scenario in a downward trending market that evolved over the 3 sessions. 1 push, 2 push, 3 pushes against the trend.
Yesterday's high, yesterday's low. Now sometimes you'll get a trend trade that if the market was coming down, we may get the market breaking out in Asia, extending the move in London, and continuing the trend in the US session. So again, they push against the trend, but it keeps making new lows. That can be 3 pushes with the trend. So 1 push down, 2 pushes down, 3 pushes down, and we have our trend line and possibly an ascending triangle or something, but that's with the trend.
Here's a great example of a trending day in an up market. We have an immediate break through the previous day's high in the Asian session, and the market takes out the high from the previous 2 days, but the market breaks out in Asia, extends the range into the Europe Open. Traders can position themselves right in the thesis, right in the beginning of that 12 candle window on the breakout candle, because that market is trending and it's made a strong indication that that market is about to do a range expansion. So we've moved 50 pips and the market is trending, and we're entering into the trend with a 1 bar stop at the beginning of the 12 candle window. If people wanted to wait for a pullback continuation reversal, the problem with the market when it's an all-in day like this is that you don't often get a chance to get back into the market. Now, we did get an opportunity in that gap time between the London and US Open, the 3-hour window. We had 1 push, 2 push, 3 pushes, and a 3-bar reversal just prior to the US session open. But again, you can see on a day when it's an all-in trend day that it's a matter of positioning yourself at the beginning of the session if the market is in a breakout, and it is an all-in type of day where the market has been trending, and immediately the market breaks, has very little pullback, goes into consolidation. Engulfments, again, for a continuation, you'll notice it's at numbers. People who ask, where do you get in? Okay, engulfments. This is an example when you have an existing engulfment. So you have a trend that's already in place with the trend. It's an all-in type day. It's a trend day. There's a trade that's taken place, 1 push, 2 push, and a continuation, hammer, engulfment, continuation just at the beginning of the Europe Open. You position yourself in the breakout with a 1 bar stop. In a strong market, the thesis is that this market will continue to trend, and any indication of that being wrong, you'll know in 1 bar. But as you can see, the market does not often give you an opportunity to get back into the trend. Now we can see a 1, 2, 3 bear candles, and then again a continuation engulfment, which is another example of a 1 bar stop. But at the further we go, you can see that the market had a creeping trend down. It layered on top of the second continuation for again a 1 bar engulfment and a 1, 2, 3 into the new trend day. Another example of a sell high setup in an example inside of the range of the previous day's session in a strong trending downward market. The market comes out in the gap time, hits the lows of the Asian session, reverses, engulfs, and then pin hammer first candle of the Europe London 12 candle window for a 50 pip stop hunt to the high of the day before engulfing. So traders have gone long, counter trend, broke out first to the downside, long to the upside, engulfment, sell high setup at the high of the day in a downward trending market. For the sell high, the market breaks out of the previous day's low. Now we have 1 push, 2 push, and a 1, 2, 3 for a continuation and a measured move with the trend in a downward trending market. So again, traders ask, where do you get in? Engulfments at the high of the day. Engulfments with the trend at the high of the day. Now you'll notice this is the first candle of the second hour. We talked about the last candle and the first candle on the hourly rotation as being significant. So some traders have traded the reversal as the trade. That's the stop hunt counter trend to the overall downward trending market. We go into the US session, the market has already broken out of the previous day's range. We have a stop hunt back into the range. Continuation. And then a 1 push, 2 push, 3 push pattern. Where do you get in? A break of either the bull candle on the third push, and again, that's just prior to the end of the hour, or the shift candle that engulfs it, back with the trend. You're in a downward trending market. We have a sell high setup, then a breakout, pullback, continuation in a downward trending market. And you can see in the next morning, it blew off for a 100 pip stop hunt through the next day's low. But again, a sell high setup in a downward trending market. The market had been moving down for consecutive days. Just an example of the false break reversal against a very strong trend. So again, another downward trend. The market on the close of the U.S. session broke through the previous day's high in a downtrend before pulling back, and then into the next day we get an engulfment right off the bat into the open of the rollover session. So again, now we have not only a false break reversal in a downtrend off of a previous day's low, but we also have, I'll just move this over, an engulfment. So we have two existing short trades in place. So an example of where when we come to the market, if we're not trading Asia, we see the market continue the move down in Asia. We see a pullback in the 3-hour window, and then dropping down again and consolidating, and then a breakout pullback as we saw earlier in the other examples. This breakout pullback in the first hour is very common, sometimes in the second hour. But then we have an engulfment continuation in a downtrend. This is an example of a false break reversal with the trend. False break reversal with the trend. And that market continues to trend. And again, evidence of the stop hunt against the traders who are in the right position. The market will still come back to try and get you. Consolidation. So they give an engulfment at the previous day's low, trapping traders counter trending. We've got a strong trend, and some traders would counter trend this after just a 1, 2, 3 down on one bar. So again, an example of just not jumping in front of a freight train or trying to catch a falling knife. We get 1 push, 2 pushes, and then a third push just prior to the 7 o'clock stop hunt, and then a reversal engulfment with the trend. So at the low of the day, we get the 3 push pattern against the trend for the continuation into the U.S. session 12 candle window. Just an example again, a false break reversal against the trend on the previous day's high into the next day. The market gives us another engulfment with the existing downward trend after the reversal off the previous day's high. You have to be thinking the most recent session low, which would be the U.S. session low, which also turned out to be the previous low of the day. And again, the previous one 2 days earlier was just below that, but the market, after false break reversal, came into the next day's session, continued the downward move, breakout pullback, consolidation, breakout pullback, consolidation, continuation all the way through for an example of a trending day with the trend after the false break reversal.
The other scenario is we could have a downtrend and the market stays inside of the previous day's high and low, and it goes the other way against the trend. Asia, London, New York. So the market doesn't break the previous day's high or low, it stays inside, breaks out to new highs, trapping traders wanting to go long against the downtrend. They short the market up here, chasing the trend, but it only gets maybe 30 to 40, maybe 50 pips. And then in the US session in the gap time, comes back, takes out the highs, the US Open, or in that first hour, 12 candles, 12 candles, 12 candles, takes out the high, usually on a 1, 2, 3 before reversing, back with the trend, and a continuation down through the low of the day. Really important because, again, traders are trading this, trying to figure out why it's not going anywhere, and what they're actually doing is they're consolidating the volume over the longer time of the day and putting in 3 peaks for the continuation back down with the downtrend. So these are the basic setups. The same things apply in the long direction.
This is a variation of a sell high setup in a very strong downward moving market. We have the pound New Zealand. It's been in an expanded range, a breakout in a downward trend. We have the low of the week. The next day we trade off of the US session lows inside of the low of the week. The market makes one push in Asia. Even though we have 1, 2, 3 pushes in the session itself, we have an example of where the 3 sessions formed the 3 peaks over the course of the day for a sell high setup in the US session. So again, we talked about we want to be selling high in a downward market. This market did not take out a previous day's high or low, but you'll notice the previous day prior to that, 2 days earlier, the low which the market broke through became the testing area high for the 1 push, 2 push, 3 pushes over 3 sessions and an engulfment. So again, people ask, well, where do you get in? Okay, so in the gap time, there's an engulfment that takes place. Some traders may have traded this, and there's nothing wrong with that. We had a 3rd push to a high, stop hunt high in the gap time, 7 o'clock stop hunt. This is an existing trade as we head into the next session. The market comes down, pulls back, stop hunts traders that are short already. Into the US Open, we have a breakout pullback. Okay, it's a variation of the breakout pullback for a 50 pip move down to the low of the week. And you'll notice the market did not go through the blue line, which was the previous day's low, but an example again, a variation of 1 push, 2 push, 3 pushes to the high for the sell high in a downtrend scenario. And you'll also notice we have consolidation, and then we have a range expansion where we hit the stops, and then we come down in London and we hit the stops one more time, trapping traders on both sides chasing the moves, when in reality what we want to be looking for is a sell high setup in a downtrend. So again, even if you traded the high of Europe, you're chasing the move. You notice they give you a fill inside of the 25 pip box, but you have a 1, 2, 3 down. You'd have to be going to break even, taking profits, or being prepared for the market to come back. And you notice after the 1, 2, 3, there's an engulfment long sideways pin hammer at the beginning of the 4th hour for the 1, 2 sideways 3 to the high in the 7 o'clock stop hunt. So again, if you're shorting the market, you want to be selling high. If you're entering into the continuation after an existing trade, there's your little bar on the breakout pullback, trapping traders chasing longs when it's a downtrend for the stop hunt to the low for 50 pips. 1, 2, 3 in a downtrend that has not taken out a higher low from the previous day.
So we talked about we can get 3 peaks for the move back up. That's a buy low setup in an uptrend. Doesn't take out the previous day's high or low. Okay? We're looking for the continuation of the trend. It stays inside. They're dragging us lower before reversing the market and finally taking out the previous day's high. So in an uptrend, we want to be buying low. In a downtrend, we want to be selling high. Some traders have asked, how do you determine the trend? Well, the first thing I look for is obviously a market that's broken out, or possibly what market profile people used to say is out of balance. And typically, again, if you study Peter Brandt's work or Schabacher, if we have these longer consolidations over a daily or weekly time frame, and we have a breakout, most breakouts will fail, so this is either going to come back inside or continue for a range expansion, at least maybe 1 times that distance, maybe 2, or more, depending on the strength of the move. So whenever we have consolidation, the market is building up a lot of pressure. Like, I like the analogy Peter Brandt used, it's holding a beach ball under the water, and eventually it pops up. And when this market goes, these are the days, again, there's a cycle Monday to Friday. We could be in the beginning of an up template now for a range expansion, and when we use our 12 candle window to participate in these trends, that's when we can start to take these positions and they move 50, 100, 150 pips. But generally speaking, we want to trade with the trend. So again, we want to be buying low in an uptrend. We want to be selling high in a downtrend. I hope that makes sense, and making those part of your best trade setup in your playbook. So hopefully you got some value out of today's video, traders. Keep it really simple. Trade with the trend. And again, I think we're at a great time right now. The opportunities are there. Be patient, be disciplined, stick with the trend, and may the markets go with you.
Hi traders, it's Stacy Burke from Stacy Burke Trading. If you haven't done so, please head over to my website at stacyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.